Hi everyone, it's me, your manuishu, and welcome to my YouTube channel, manuishu ACCA classes. In today's video, we are going to do section A part of tangible non-current assets, okay, of Act 7. So if you are watching my video for the first time, please like and subscribe to my channel and don't forget to hit the bell icon for the more updates in the future. And also share my video channel link with your friends so they could also have the benefit. Okay. So question number 24. What will be the total amount capitalized in respect of the factory? Okay, we have given certain items and their respective costs. So we have to find out of these which cost we can capitalize in respect of the factory and which we can't. Okay. The first is the land, material, land cost is obviously we will capitalize, so it's a capital expenditure in nature. So we will capitalize the land cost, okay, and material and labor. Material and labor cost will also be capitalized until and unless question has been told that there is having extra labor charge or have wastage of material due to the default design or any kind of mistake we have done due to that we have occurred additional material and labor cost. We won't capitalize that amount. Okay, but in this question, nothing such a point have been indicated. So simply the material and labor cost have been given in the question, so we will capitalize the material and labor cost. Architecture fees and surveyor fees. So any kind of professional fees we will capitalize. So both these fees will be capitalized. Site overhead. Okay. So if you like to note down, you can note down. Certain key point I would like to say. Okay. So trial and test, any alternation, modification, cost or borrowing cost, we can say dismantling cost, site overhead, delivery cost, installation cost, non-refundable tax, custom duty, excise duty, all these should be capitalized. Okay, so site overhead will be capitalized. A portion of administrative overhead, we won't capitalize this item because it is revenue expenditure in nature. So that's why we won't capitalize the administrative overhead. Testing of fire alarm. Yes, as I told a few minutes ago that trial and test cost will be capitalized. So obviously we will capitalize this cost as well. Business rate for the first year. Business rate for the first year, it's like a revenue expenditure, so we won't capitalize it. So rest all the costs will be capitalized except the portion of the administrative overhead and business rate for the first year. And I have drawn. You can have a look on this picture. So answer is 6950. Okay. Okay. So next question is, let's first read out what the requirement of the question is. Calculate the borrowing cost which can be capitalized in respect of this project for the year ended 31st December 20x8. So in respect of the borrowing cost, I would like to address a few points, like if you have taken any loan amount for the, especially for the creation or construction of any assets, so and whatever the interest you are paying in respect of that loan, we will capitalize those items if certain conditions are made. Only in that case we will capitalize those interest expenditure as well. So let's do the question. You will have a more clear picture of this concept. Okay. So question is, calculate the borrowing cost which can be capitalized in respect of this project for the year ended 31st December 20x8. Carry Waste Company had the following bank loan outstanding during the whole of 20x8, which from the company general borrowing for the year. So 9% loan repayable 20x9, 15 million, 11% loan repayable 20x2, 20xy, 20y2, 24 million. Carry Waste Company began construction of the qualifying asset on 1 April 2006 and withdrew the fund of 6 million on that date due to the fund construction on 1st August, and additional 2 million was returned for the same purpose. Okay, so in this question we have given it two different interest rate as well as two different loan amount. Okay, so we will calculate first weighted average cost of borrowing. And how we will calculate this? Just have a look on the formula bar. What I did, I simply took the 9% and their respective loan amount, multiply it by the respective loan amount, which is 15 million. So 9% into 15 million plus I have taken 11% on their respective loan amount, which is 24 million, and divided it by the total loan amount, which is 39. So I got an interest rate, and I will use this interest rate for the further calculation. So interest expense which we can capitalize. So we have taken the interest first on the 1 April 20XX, and our year end is 31st December 20XX. So what is the total month? It's April, May, June, July, August, September, October, November, December. So altogether 9 months, and this interest is for the whole year. So we will just have a look on the formula bar. I have simply multiplied the loan amount which we have withdrawn, that is 6 million, okay, and multiply it by the interest rate which we calculated above, so E2, and as it has been 9 months, so we will multiply it by 9 divided by 12. Okay, we will get a certain amount. And same we will do for the interest loan amount which we have withdrawn on the 1st August 20XX. So what is the total month? August, September, October, November, December. So altogether 5 months. So just have a look on the formula bar. What I did, I simply took the loan amount, which is 2 million we have withdrawn, and multiply with it with the interest rate, and again multiply it with the 5 by 12, because it has been 5 months of we haven't taken the loan. So interest rate is for the whole year. Okay, so together we will add this amount, we will get this 54561. So we don't have any kind of option like this due to having the rounding of the decimal point. So don't worry, just tick on the which is the nearest of this answer, which is the first. Okay. Okay, so next question, calculate the borrowing cost to be capitalized for the year ended 31st December 20X9 in the respect of this project. Again, we having a same question. Let's read out the question. Leases company borrowed 2.4 million to finance the building of the factory, and construction is expected to take 2 years, and loan was drawn down on 1st January 20X9, and work began on 1st March 20X9, and 1 million of the loan was not utilized until the 1st July 20X9. So later was able to invest it until needed, and later companies paying 8% loan and can invest surplus for at 6%. Okay, so here we are having a little bit different scenario than the previous question. Okay, so in borrowing cost, if suppose we have borrowed the amount, we will take the portion as example. Suppose here the company has borrowed 22.4 million, right? So not all the amount we will spend in the one day. So we will might require the certain amount of money, and certain money will be idle. So what the company will do, the company will invest the idle money which company will not require to invest and get a return as interest. So company will earn a interest income on that idle money. So similarly, the case having in the question, 1 million of loan was not utilized until the 1 July 2009. So company have invested it until needed and earning a interest on this loan amount, right? So when we calculate the interest expense which we are paying on the loan we have taken, so we will minus this interest income. Okay, So we won't capitalize this interest income, so we will deduct this amount from the interest expense. And one more thing we have to pay attention is, as the company has taken loan on 1st January 20x9, but working began from the 1st March 20x9. So we will calculate the loan amount from the loan amount interest from the 1 March 20x9, not from the 1 January 20x9. Okay, so just have a look on the formula bar. Interest expense I have calculated. I have taken 24 under the whole amount because we will pay the interest on the whole amount, not on the you might have been doing the 2.4 million minus 1 million because 1 million company have been invested elsewhere. So no, we will don't do like this. We will simply take the whole amount because we will pay interest on the whole amount. So 2400 I have taken 30 as a common, and company is paying 8% on the loan, so I will multiply it by 8%. So 8% is for the whole year. So we will calculate from the how much more, qualifying period is from the 1st March 20x9 to year ended 31st December 20x9. So it has been 10 months. So we will multiply it by 10 divided by 12. We have not taken from the January because construction have been begun from the 1st March 20x9. Company will pay the interest of the 1 January February, and but we will show the January February interest as in the as expense in the PL, but we will capitalize from the construction work have been begun. So interest income we have calculated. The company have invested 1 million in a loan amount. So I have taken 3 as a common 1,000, and company is getting the 6% return on those amounts. We will multiply with the 6%, and company have company will not require this money until 1st July 20x9. So again, we will calculate it from the date on which construction has been begun. Here, the construction has been begun from the March. So March, April, May, June. So it has been 4 months. So we will. I have multiplied by 4 by 12. So I got 20. So borrowing cost which will be capitalized is 140. I hope you are getting my points, what I'm trying to say. If you have any kind of doubt, just do let me in the comment box, and or you can just replay the video. You will have a clear-cut picture what I'm trying to say. Okay. So next question is, which of the following statement is correct regarding investment properties in accordance with the IS 40 investment property? Okay, so I would like to recap what is the IS 40 investment property is. Okay, so investment property, especially like land and land or building, if we have let it out on the rent, or we have just kept, we know that in the future its value will be increased. So we are having the purpose of capital appreciation. In that case, we won't state land or building as a PPE. Instead, we will state it as a investment property, because company has have a land and building held to earn rental or cap or for the capital appreciation, or both, rather than for the use by entity or for sale in ordinary course or of the business. It's this definition according to IS 40. So that's why we will we will do a separate treatment for this kind of land and building which we have been held for the rental or for the capital appreciation purpose. Okay. So what the question is, regarding the investment property in accordance with the IS 40. Okay, the option first is transfer to or from investment property should only be made when there is change in their uses. Just a minute. Sorry. Okay, so what the first statement is, transfer to or from investment property should only be made when there is a change in uses. Obviously, like आपने एक building लिया था, if you have given a certain if you are earlier you have been using the whole building for your business purpose, but now you have just you don't require certain portion of the building and you let it out on the rent. So if there is change in the use, obviously there is need to transfer from investment property, transfer to or from investment property should only be made when there is a change in their use. Obviously this statement is correct. Transfer from an investment property to an IAS 16 property must be made at the fair value of investment property at the date of transfer. Yes, this is also the true. If the asset, there has been a few points in the book, you can have a look on it. So, if asset is transferred from property, plant and equipment to the investment property, and if you're opting for the fair value model for investment property, then asset must be revalued as per IAS 16, okay, then transfer into the investment property at fair value. Okay, if you are using for the cost model, then you have to find out the carrying amount if you are using the cost model, the asset is transferred into the investment property at carrying amount, current carrying amount, and then we will charge a depreciation. We will continue to charge a depreciation. And same the case will goes if an asset is transferred from investment property to the PPE, and if you are opting for the fair value model, then they revalue the property first as per the IS 40, okay, and if there is any gain or loss, then take it to the statement of profit or loss, then transfer the PPE at fair value. Okay, and if you are using the cost model, in that case, asset is transferred into the PPE at current carrying amount, again continue to be depreciated. Okay, so this statement is also true. Third one is, an entity should treat any difference between measurement of IAS 16 property and measurement of IAS 40 investment property at a date transfer as explained to the profit or loss. As I told few minutes ago, that if you're transferring from investment property to PPE, if there is any difference, then we will take, if there is gain or loss, we will take it to the statement of profit or loss. So we won't consider it as expense only. So this statement is wrong. So statement 1 and 2 is correct. Okay, identify whether the following statements are true or false in accordance with IAS 40 investment property. Okay, following initial recognition, investment property can held at the either cost or fair value. Obviously, this is true. Okay, it depends whether you are opting for the cost or at the fair value. Okay, so if an investment property is held at fair value, this must be applied to all of the entity investment property. It's like when we revalue a one kind, if we revalue the suppose we revalue the building, okay, building, then we have to revalue the entire class of same assets. So this will apply same to the investment property as well. If an investment property is held at a fair value, this must be applied to all of the entities investment property. So this is also true. The investment property is initially measured at a cost, including transaction cost. This is also true. So a gain or loss arising from a change in fair value of an investment property should be recognized in the revaluation surplus. Bilkul nahi, this statement is false. As I told, if there is any gain or loss arising with the change in the fair value, we will simply take it to the P&L, not in the revaluation process. So this last receiving this call. Okay, so what amount should we capitalize as a borrowing cost at 31st December 2008 in respect of this asset? Okay, this question is like we did earlier, so I would like to you guys to try once by yourself. If you still have a doubt, please let me know. I will try to help you out. Okay. Okay. What amount will be charged to profit or loss for the year in the 31st March 2008 in respect of the depreciation on this machine? Whether by company purchased a machine on 1st July 2007 for 500,000, it is being depreciated a straight line basis over its useful life of 10 years. Okay, so it has been purchased on the 1 July and our year in the 31st March 2008, so total 9 months. Okay, and it is being depreciated on a straight line basis over its useful life of 10 years. So residual value is estimated to at 20,000 on 1st January 2008. Following a change in the legislation, whether a company fitted a safety guard to the machine, and this safety guard cost 25,000 and has a useful life of 5 years with no residual value. Okay. Okay. So cost of machine is at 500,000. Okay, just have a look on the formula bar. The cost of machine is 500,000. So, and it has been 9 months. So we have been purchased the machine. Okay, and it has machine also have a residual value. We can also say the scrap value when its useful life in. So we will deduct this residual value 20,000 from the cost of the machine. Then we will divide it by the company useful life, which is given in the question, that is 10 years. So we will get the depreciation for the 1 year. As it has been 9 months, we have been purchased the machine, so we will multiply it by 9 divided by 12. So we got 36,000 as a depreciation for the machine, right? And if now the certain legislation has been changed, whereby company fitted a safety guard which cost 25,000. Okay, and the safety guard has a useful life of 5 years with no residual value. So we will simply take a 25,000 cost and divide it by useful life. So we will get the depreciation for the whole year, but it has been 3 months because the safety guard has been fitted on the 1st January 2008 and year ending 31st March 2008. So it has been 3 months. So we will multiply it by 3 divided by 12. So total depreciation, total charge to PL is 37250. Okay. So next is Aqualand company purchased a machine for 60,000 on 1st January 2007 and assigned it to a useful life of 15 years. On 31st March 2009, it was valued to 64,000 with no change in the useful life. What will be depreciation charge in relation to this machine in the financial statement of Aqualand company for the year ending 31st December 2009? So this question have been we have done similar kind of question in the F3. So try it by yourself. If you have still doubts, please let me know in the comment box. Okay, so let's do the last question of this chapter. Cattle company vacated its head office building and let it out to the third party. So it's like a we have earlier using for like building, sorry, head of building as PP. Now we haven't let it out, so it has been converted into the investment property according to IS 40. On 30 June 20X8, and the building had a original cost of 900,000 on 1st January 20X0 and was being depreciated over 50 years. It was judged to have a fair value on 30 June 20X8 of 950,000, and at the year ended date of 31st December 20X8, the fair value of building was estimated at 1.2 million. Capital company used a fair value model of for the investment property. What amount to be shown in the development surplus at 31st December 20X8 index of the building? Okay. So building has originally cost of 900,000 on 4th January 20X0. So now the year ended 31st December 20X8. It means it has been 9 years, right? So as building has been let out on 30 June 20X8. So we calculate the depreciation for the 8.5 months. So 8.5 years, right? So let's calculate. Okay. So we have purchased the building on 1st January 20X. It will be 0, not 7. Okay, so we have been purchased the building on 1st January 20X0. The cost was 900,000, right? And I have calculated depreciation for the 8.5 years because during the 20X8 on 30 June 20X8, the company have let out the building to third parties. So the building has been transferred from the PP to investment property. So what were the rules as I told in the previous question? If the asset is transferred from PPE to investment property, if company is using the fair value method, we have to first revalue as per IAS 16. So now carrying amount of the asset is 747,000, but on 30 June, when it has been transferred to investment property, the fair value of the building was 950,000. So, revaluation surplus will be 950,000 minus 747,000. We will get 203,000. Okay, and we won't take the 1,200 million because sorry, I do have a problem while speaking. First, we have to revalue as per IAS 16, then transfer it into the investment property at the fair value. And if there is any gain or loss, we will take it to the P&L. Okay, so we won't take the 12 million. So we will take the on the revaluation surplus or fair value which has been right on the 30 date of transfer, which is 30 June 20X8. Okay. I hope you guys understanding my point of what I'm trying to say. So this much for this video, and this portion I will do in the next video. So thank you guys for watching my video. And if you do have a query, any kind of query, so let me know in the comment box. I will try you to help out. So thank you so much for watching my video.